Hey, welcome back. Getting back to the sub-recommended companies. This time we have 3 stocks that might even be potential buys right now. Again, if you have a suggestion or want me to cover any of this again in the future, let me know in a comment. Before we begin, make sure to leave a like and check out the rest of the series after this one. It's tens of hours of work for each of these videos. To begin with UiPath, they are a leading company in the robotic process automation, so basically making bots to automate all the repetitive things that go on in a company. This can be useful to some degree in any company. Think about processing invoices, orders, inventory management, price comparisons, customer support, and so on. It isn't necessarily something new, I mean they've been doing it for like 2 decades now, but with AI, the capabilities of these bots can really be improved. And the adoption of this kind of software isn't that high at the moment, so there is a lot of potential in the future. The stock fell significantly since the IPO in 2021, falling like 80% from 75-80 per share to around 10. At some point, this was a roughly $35 billion company compared to 7 today. So you can see how volatile this pandemic hype IPOs can be. Back then, there was a frenzy in the market and any IPO could have made billions. They recently crashed like 35% in a single day following the Q1 earnings. The revenue was at the high end of the guidance, but the recurring subscription revenue, which potentially shows the future, was at the lower end. The founder also came back as CEO after like 5 months of stepping down and becoming the Chief Innovation Officer focusing on AI. Of course, with the stock crashing, you have analysts cutting their targets just to be in line with the market, but that's normal. I really can't see how people listen to this kind of people. Cutting the target in half or even less probably wasn't even because of the guidance. I think it's because the price fell, so it would have to like triple for you to be right. You know, what happened to the company in that 1 quarter to suddenly make them think it should be worth half or even less? Or how did you get to the original target? And if it doubles back to the previous price, everyone will probably bring back the previous targets. And the thing is, it's not 2 people, it's basically everyone, and that's how the market works. If you look at my previous targets for PayPal or Intel for example, I have the same targets 2 years ago as I do now, with some adjustments based on recent developments, but nothing significantly different. A company doesn't become half overnight, and I guess the difference is that I focus on the company's long-term potential. The revenue pretty much doubled in the past 3 years, and that's also visible in the cash flow, which is great. A year ago, they made around 300 million in cash flows, putting them at a ratio of around 20. In comparison, Palantir, which I talked about recently, has a similar growth potential but is traded at like 80 times last year's cash flow. They issued a bit during the years, but like 10% in half a decade, so nothing to worry about, despite paying pretty high stock-based compensation. I think this is another example of reality versus market expectations. Yes, the company can grow a lot, but you have to think about how much you pay for that. Eventually, it's very likely to see the stock following the company, but in relation to the other options in the market. If you buy at like 50 times the revenue, it's very likely to see the price normalize in time, even if the company grows significantly. You know, buying this in 2021 for 50, 60, 70, not knowing what they can make was just a gamble. The company more than doubled the revenue in that time, which is amazing, but the stock is down 80%, showing how the valuation is very important even for growth stocks. Financially, they are in a very good position, with the current assets covering the total liabilities a few times, but they don't really have that much else. They have about 2 billion in cash and securities, which is pretty much the same as the equity, which is not terrible for a 7 billion market cap for a tech company. This financial position can offer a lot of potential to grow in the future because 1. They have a lot of cash, and 2. They can get into debt and then the growth could really begin. It's not really the time to do it, I think, because of the high rates, which also slow down the economy, but when they are cut, this can be a potential catalyst. Such a high growth company at only 20 times today's cash flow is definitely interesting. You know, with so much potential to grow, this ratio can be the equivalent of like 5 in less than a decade. If they manage to grow so much, the market won't keep it at 5, and if they get to like 25, 30, that's a 5-6x from the current price. And that would probably take a revenue of like 5-6 billion, which sure is a lot of money for them today, but it isn't a lot for the industry. But at the end of the day, it's a bet on the company's potential to grow. Still, 20 times the current cash flow for a company with so much potential might be a pretty good margin of safety. Sure, it's not the usual 5 or 10x that I prefer, but we have to adjust it for each company. Maybe it's not a buy for me yet, but I'll definitely keep an eye on them. Now, Alibaba. This one has been affected a lot following the crackdown of the Chinese government and SoftBank selling their stake, and so far it hasn't recovered. They make most of the money from the e-commerce platforms, plus things like the cloud business, international commerce, logistics, services, digital media, and more. In a way, they are kind of similar to Amazon, but in a much early stage, before expanding so much. We can see significant increases in revenue in the international e-commerce and logistics, and overall the revenue grew by around 7%. The net income fell significantly, but mostly due to valuation changes in some investments. Adjusted, it fell by 11% compared to Q1 last year, but it increased by 11% compared to the previous 12 months. So, looking at the bigger picture, it's not bad. Overall, the growth in the other segments of the business is very impressive. International e-commerce and logistics are actually two of the very high potential growth engines of the company, and in the future they can unlock a huge amount of value. You know, we saw Temu developing in the US and Europe literally overnight to the point where they have a significant market share. Despite being valued the same, Alibaba is many times bigger from any point of view, so they have the resources to do the same. They can make around 15 to 25 billion in cash flows. For a roughly 200 billion market cap, that's a ratio of around 10, which is generally very good for a tech company. This kind of valuation, together with having pretty much zero debt obligations, allows them to pay massive dividends and buybacks, as you are about to see in a second. Comparing them to Amazon, for example, which is at a ratio of like 35 to 40, they are extremely cheap. Financially, they are in an excellent position, with the current assets covering the total liabilities. They have very little debt, so they only pay like $1 billion in interest. This is comparable to a company like Google, which makes about 3 times more money, but is valued at like 11 times more than Alibaba, and that's one of the cheaper tech stocks. But you have to factor in the political risk and the fact that due to the VIE structure, you don't really own a piece of the company, it's more like a contract for difference. But still, even if you are allowed to own the real thing, it wouldn't really make a difference if China had some issues or they just decided to not allow you anymore. You know, we saw with Russia, and I can tell you from experience, since I have Russian stocks which are blocked, that this is entirely up to them. This is a reason why American or European stocks are generally traded at a higher price than emerging markets, for example. As a note, the equity is very close to the market cap, which is really an achievement for a tech company. Companies like Alphabet or Amazon have a very similar equity, but again, the market cap is nowhere near this level. They recently had an almost 5 billion convertible note offering for an interest of only 0.5%. They are due in 2031 and have an initial conversion price of 105 per share, meaning a 30% premium from the current price. They want to use the money for buybacks, so they potentially dilute up to, let's say, the equivalent of 2.5% now in the future and put all the resources they have into buybacks today. 4.5 or 5 billion in 7 years from now can be like a 1% or even less dilution. They are even kept at 161 per share, and there are a few more details which I encourage you to read. There is another point I'm trying to make. Overall, I think it's a really good idea to do it now when the price is down so much. This isn't a lot of money, but they are in a position where they can offer a 0.5% convertible note in the current market and have enough demand for it. This is, in a way, something that shows how there is so much interest and even demand for this company. I think the selling pressure from SoftBank is partially the reason why the stock is still so low despite all the buybacks. In case you want to see more details, I have a video where I talk about this and even do a valuation for Alibaba. They pay a small, like 2% dividend, but the main attraction are the buybacks. They have over 30 billion available for buybacks until early 2027, so over 15% of the company. All the buybacks and potential growth in cash flow, even with the ones that they issue for employee benefits, can offer a lot of value. Even if the market cap doesn't change, this can still be profitable. You know, looking on a per share basis, you'd get more of the company, and the value of a share would have to go up for the market cap to remain at 200 billion. The thing with the buybacks is that they often tend to add more to the market cap than the company actually spends. This is a matter of liquidity, and to buy, someone has to sell. Okay, they had SoftBank selling a lot, so there was enough to buy from, but with so many buybacks, who's gonna keep selling so much? I get it if the price was double or something and people would take a profit, but who would keep selling at 80 for 5 years by the time they finish the current buyback program? On top of internal politics, we have to keep in mind things like fuel prices, competition or tariffs, all of which can have a negative impact on the expansion. But on the bright side, an improvement in the global economy can be the catalyst needed for a lot of growth. I have quite a bit of Alibaba and I think that this is overall a very good company. For a tech stock with potential to grow thanks especially to international expansion, and we saw Temu recently, they are very cheap. If they continue to make even 20 billion per year and spend so much on buybacks and dividends, that alone can be a very good return. But I think that eventually it's very likely to see the buybacks having a meaningful impact on the price. And then, if they want to, they can focus on paying the equivalent of a 5, 6, 8% dividend today using the same money. And with the focus on improving the business and expansion, they realistically have a lot of potential. One more thing I have to mention, yes, they are relatively cheap comparing them to Amazon and the rest, but for a Chinese company, they aren't that cheap. So you have to keep that in mind. Any disruption from the government, including the American one if you are from the US, can potentially lead to a significant loss. But overall for me, I think this is a good risk and reward potential. Now, ACRE is commercial real estate. They invest in real estate mostly through senior mortgage loans, with a majority of that being in office and multifamily properties. The stock fell a lot lately and it even got to the all-time low from 2020. The problem is that following the pandemic and high rates, this kind of property could be in trouble. They are already selling some loans at a loss to reduce the risk. They pay a dividend of around 14%, which, as you are about to see, is a main concern for the market, as many people expect another cut following one a few months ago. Financially, they are okay, with the total assets covering the total liabilities. They are focused on reducing the debt, which is definitely good, and we can see an 8% reduction in Q1. On a roughly 400 million market cap, you get 600 million in equity, so pretty good, but you have to remember that if they have to sell them, that might be in a time with issues. If that's the case, discount let's say 20-30% of the asset value and then the difference isn't that high. Again, they are already selling assets at a loss. But if the clients have issues and they delay payments or even default, it can take years to get the money back. Pretty much all the financing and loans and stuff have the maturity in about 1 year, so unless they refinance, that can be a very serious issue. So you can see why they have to sell at a loss. And if they do refinance, then the interest would probably be higher, so unless something changes, they could be heading on a dangerous trajectory. And they also have a lot of CLO securitization debt. But they were in a very similar scenario even back in 2021 and they just refinanced and pushed them like 4 years into the future, so it may not be such a big issue, especially if the rates are cut. They recently cut the dividend from 0.33 to 0.25 per share, but even that might not be safe. They reported a negative income in Q1 due to the realized losses on the loans that they sold, which is good for tax purposes. It also reduces the risk, but as a REIT, they have to pay at least 90% of the taxable income as dividends. If it's negative, they have no obligation to pay it, so it's ultimately up to the management. You know, they can just say, we are currently rebalancing, so no dividend for a couple of years. We can see that since a few years ago, the net income has issues because of provisions on credit losses and actual losses. They do this kind of rebalancing to reduce the risk and ensure debt repayments. Without this, so in a normal environment, they can probably make like 60 to 65 million per year, meaning that the current and even the previous dividend should be pretty sustainable for a REIT. But that is unless they have some issues. I looked into a sister company of theirs back in the second episode of the series, so make sure to check it out as well. That one is bigger and more stable, although it has a lower dividend of around 9%, which is still very attractive. A spoiler, it's not really a buy for me right now, but in the right environment, they can offer a once-in-a-decade opportunity to lock in some 20% dividends, so I've added them to my watch list. They are part of the huge ACRE group, with the management company being valued at like 40 billion after pretty much quintupling in the past half a decade. I may look into them as well in the future if you want. Now, there is a question of whether, in case of serious issues, the bigger ACRE management company that's managing this one as well wouldn't, let's say, lend a hand. Something like a $100 million loan shouldn't be significant for a $40 billion company, although that one actually has negative cash flows. On the other hand, ACRE's management failing somehow could have a big impact on this one and all the other smaller companies that they are managing. I think if you want to invest in any company from the ACRE's group, you should also look into the management one. It's important to have a broad look into all of them because Ivy Hill Asset Management, for example, which operates some of these companies' assets, is owned by ACRE's Capital, the sister company that I mentioned before. So they don't own a stake in each other, but they are very tied together. I can say that ACRE's Capital is okay, but I haven't looked into the management one. Ultimately, this isn't such a bad company, and at the current price, it can offer a very nice upside plus a massive long-term dividend. The stock can crash even more if the Fed keeps delaying the rate cuts and they decide to cut the dividend again, but in the long term, I don't think this one is that risky. You know, I think that even for a 10% dividend it would be an okay risk and reward. 14% is already very good. So I'm adding this to my watch list, but before I do anything, I'll have to look into probably every company in the ACRE's group. I recommend you do the same in case you're interested, because even though I haven't mentioned everything, there are so many ties between all of them. Anything bad happening to ACRE's management or even capital can really disturb all of them. Overall, 3 very interesting companies. I have some Alibaba and I'm definitely going to add the other 2 to the watch list. I think Alibaba is a buy for me for sure, ACRE's is interesting but needs a bit more research, and UiPath is also getting there. Once again, if you have a suggestion, let me know what's attractive about them in the comments. If you like any of these and would want me to cover them in more detail in the future, also let me know. Again, if you like this kind of video, make sure to check out the rest of the series. So far in 6 episodes, I can say there have been a dozen of very interesting companies and I've added a bunch of them to my watch list. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.